Hi, welcome back to the channel. My name is Dave, and today I want to talk about my top sector ETF for 2022. Now, this is an ETF that I've had for a couple of years and has performed remarkably well, and I think it's going to continue that performance for the rest of 2022 and into 2023. I think it offers great value. It offers great potential growth. Combine all that, and I think we've got a bright, bright future. So if that's what you're looking for, please stick around. Whoop. So back in December, Bank of America predicted that the S&P 500 would slump in 2022, but it still had a belief in three sectors. And those three sectors were energy, financial, and healthcare. Those are the three that they're betting on going into 2022. So if we look at the 2021 sector returns, we're going to find that energy, real estate, and financials were the top three, and they really outpaced the S&P 500 index. So if you bet in those sectors, you're doing quite well. So can we have any belief that these are going to repeat in 2022? Well, I do. I believe that the financial sector has very little downside and a huge upside potential. Just like Bank of America betting on themselves, coming out and saying, I think banks look good for 2022. So I'm betting with Bank of America. The banking sector is a great choice for value investors. If you're looking for stocks trading below intrinsic value, look to banking. If you're looking for a nice little dividend, I give you banking. So for me, I've always had Citigroup, JP Morgan, and Morgan Stanley. I've jumped in and out of a few others. I should have had Wells Fargo because they're the ones that came out and really killed earnings this last week. But in general, this last week, the Dow dropped 200 points Friday as bank stocks got hit, right? Market post second losing week to start 2022. So we're off to a little bit of a rough start. That means banking stocks have pulled back just a little. They've still been on a really good run. But now's the time maybe to pick up some shares. But since I didn't pick it right, maybe I should do this somehow. How should I do it? I know, an ETF. So my go-to ETF when it comes to the financial sector is XLF, the Financial Select Sector Spider Fund. Now the XLF tracks an index of S&P 500 financial stocks weighted by market cap. It kind of ignores the small caps, focuses on the big boys, the big banks, big insurance companies. It's got them all in there. And I think instead of me trying to pick out the next hot bank stock, I'll just be investing into XLF. So if we take a look at the chart for XLF, you're going to see that at the end of 2021, it finished right around $40 a share. It had an outstanding 2021. But with it at a 52-week high, it does beg the question, are we too late? With the interest rate hikes that are coming, that will benefit banks, are these already baked into the price? And I certainly don't think so. I think that 2022 looks good, and 2023 we're going to see additional rate hikes. And the banks are going to really benefit from these rate hikes. At the same time, the opposite side, if I was going to take the opposite side, I'd say, well, yeah, but we're going to have increased costs, maybe reduced borrowing because we're going to have higher rates. But I don't think so. I think the economy is robust. We've printed a ton of money that's out there. People are going to continue to build houses. They're going to continue to borrow. They're going to continue to use those credit cards that they love so much. So I think JP Morgan, for example, they had an outstanding 2021. Just finished up the year making the most money they've ever made. I think that's going to continue moving forward. You're going to utilize these banks, and I think it's a great time to be buying into XLF, even with it at a 52-week high. So right now you can buy XLF for $40.83. It did drop 1% on Friday like we discussed. And it does pay a quarterly dividend of about 1.5%. The vast majority of the holdings are right here in the United States of America. And over the last year, it's returned about 34.8%. So last year it was outstanding. And even over the last 3 years, over 20%. It's been on quite a tear. Over the last 10 years, 16%. We always look at these ETFs recently. Over the last 10 years, they've been on an outstanding run. Now, we should look at the net expense ratio. It is 0.12%, and you're going to see some similar ETFs here. If we zoom in on these, we can see that, there are some other comparable product out there, and you might get to pay a little bit less net expense ratio. So there are other options in here, and I would say after digging around in this, one of the biggest things to consider is your feelings on Berkshire Hathaway. So we'll get into that a little bit more down the road. But XLF does have a lot of Berkshire in there, and that's their number one holding. So if you are not thrilled about that, and we'll talk through these reasons a little bit towards the end, then you can look at some of these other ones, other similar ETFs that are listed here, and see if something might fit you a little bit better. I like XLF, but it doesn't mean these other ones aren't great products as well. So something to consider. And XLF keeps the portfolio composition quite simple. It's banks, just like we talked about, capital markets, and insurance. Throw in a little bit, diversified financial services and consumer finance, and you've got XLF. So with XLF, you're going to primarily be exposed to North America at over 97%. Just a little bit of Europe thrown in there at 2.6%. But when we're buying this XLF or another financial sector ETF, we're buying value. So if we look at the fund characteristics down here, you have a price to earnings of 11.67, price to book of 1.67, price to sales of 2.78. Again, value plus about a 1.5% dividend that you're going to get paid every quarter. Now, throw in that the technical analysis, look, everybody agrees with us. Strong, strong, strong. Now, I don't put a lot into that, but hey, it's always nice to see that they agree with us, right? If we're going down this road. If we start looking at the top 10 holdings, we're going to see Berkshire Class B shares. I'm not sure why they couldn't have sprung for the A shares, but whatever their reasoning is, 12.67%. So we'll talk more again about Berkshire B and how we might feel about that here in a minute. It's also got JP Morgan at over 10%. We got Bank of America at 7.4%. Wells Fargo, Morgan Stanley, BlackRock, Goldman Sachs, Citigroup. They're all up there and account for a lot of the value of this ETF. Now, altogether, they have 69 holdings. Positions. It's a lot. That's a lot of positions. And here is a list of all 69 of their holdings for your viewing pleasure. You can take a look down here, maybe do some research on some individual ones. Maybe it'll lead you down another path, and you'll buy an individual stock as well. But if you don't want to, you want it all packaged together, this is a great way to go through it, right? I mean, you're going to get American Express within this one. You're going to get MetLife. You're going to get the little Aflac duck. You can't go wrong with the Aflac duck. You're going to have Discover Financial Services and Fifth Third Bank. So you're going to get some smaller regional banks as well, and lots of great insurance companies. And guess what? Everybody uses insurance. So quite a diverse list, and maybe a place for you to kind of jump off and do a little more research yourself. Perhaps the biggest consideration for adding XLF to your portfolio is the exposure to Berkshire Hathaway, because you can find other financial sector ETFs that you might be able to buy that would have less exposure that might be better fit for you. So I'm adding XLF because I don't mind it, but depending on how your portfolio is set up, you might want to make an adjustment there. So in this case, just think about it. We've got over 12% in XLF is Berkshire, and they own over 42% of their portfolio is made up of Apple. So you combine those two numbers together and you get 5.4% of XLF is actually Apple. That's a little bit nuts, right? When you start talking about a financial sector ETF being 5.4% of Apple. So something to consider and think about, and make sure you're okay with that, because you might already own a bunch of Apple and not want this type of exposure. And even beyond Apple, you're going to still get exposed to some oddities within your financial sector ETF like Verizon, GM, and Heinz Ketchup, right? Heinz Ketchup's in every house in America. I'm sure Warren Buffett was thrilled when they got that. I think it was a little controversial, but I digress. I think it's an interesting hold. And if you do have Heinz Ketchup, make sure you get out of the way before Warren Buffett, because they own the vast majority of shares out there of Heinz Ketchup. So just a few oddities when you have Berkshire in there. So just something to consider and think about when you're buying XLF. But overall, I do like the exposure. And I do own individual shares of Berkshire Class B shares. So that's my position, and I don't mind adding it to my portfolio, even with Berkshire in there. You could come up with a lot of reasons to add XLF to your portfolio. I know for me, for 2022 and 2023, the primary reason are those interest rates. As they continue to rise, I think it's a good addition to a portfolio. It's just going to allow the banks to make more money if the economy continues to chug forward. Now, if we start looking at valuations, wow, valuations for banks are very attractive, especially with the Fed tightening. So I like the value that they're at right now. You combine that with rising interest rates, and I think we have a bright, bright future. I also believe that we have kind of COVID on the ropes a little bit right now. I think that's going to allow our economy to open up in 2022. So I'm thinking of travel industries and things like that are really going to start moving the economy again, and I think the banks will benefit from all of that. And finally, if you dig down a little deeper, you're going to find that commercial and industrial loans were actually up in Q4. So if big industries are actually continuing to try to grow, if we can just get people back to work, I think it looks really promising moving forward. And I think XLF is going to benefit from all of these different reasons. So those are my feelings on XLF and why I'm going to continue to add it to my portfolio with confidence. I'm going to continue to grow this position because I think 2022 and 2023 are going to be great years for this particular sector and this particular fund. I'll be adding to it. Now, if you have any questions at all about this, please ask down below. If you wouldn't mind, like and subscribe if you like any of this kind of information. See you next time. Thanks for spending some time with me. Have a great night. Take care. Whoop.